ChargePoint is one of the leading distributors of EV charging hardware in North America, and they operate one of the largest charging networks in the world. Currently, they manufacture their hardware and they sell it to other companies that go on to own and operate those chargers themselves. Most of ChargePoint's sales volume comes from what are known as Level 2 AC chargers. These charge your vehicle at a much slower rate than some of the fast chargers you may have heard of, but they're a lot cheaper to build and install than those faster counterparts. These are the three different models of AC hardware that ChargePoint is currently selling. Each of these looks fairly similar to each other, but they have different output power ratings, with the lowest one being 30 amps and the highest power one being 80 amps. Each of these models are also sold in slightly different configurations, and buyers can choose if they want a single or dual charging port and whether they'd like to mount it on the pedestal or onto a wall. But although these AC chargers is where most of ChargePoint's sales volume comes from, they have been selling more and more of these higher-powered DC fast chargers. These can charge a vehicle at a much faster rate than those slower AC chargers we just looked at, the fastest of which could only output about 19 kilowatts of power, whereas over here, with their DC fast chargers, the Express model can output up to 125 kilowatts of power, and they also have the Express Plus model that can output up to 500 kilowatts of maximum power. Although very few EV models made today are going to be able to take advantage of that full 500 kilowatts of power. But over time, more and more vehicles will probably be able to use that, so these chargers are pretty future-proof. In addition to selling hardware, ChargePoint also offers several different software products. This includes remote monitoring and analytics software for hardware owners. It includes the software powering the actual charging units themselves. It includes API access for other companies to use ChargePoint's software for their own pieces of software. It includes the network map that shows all of ChargePoint's stations, where they're located, and all of the real-time information there. And it includes the driver app that customers will use to find those chargers on the network. Now, some of the software doesn't directly generate any revenue for ChargePoint, like the driver app, but ChargePoint does require all of their customers that purchase their hardware to also subscribe to this cloud subscription service that provides the remote analytics and monitoring services. But if one of the hardware owners decided that they wanted to cancel this service, my understanding is that the hardware would no longer be able to be listed on ChargePoint's network, so no drivers would be able to see that those chargers existed, and I believe the chargers would be completely out of operation. I'm going to go over ChargePoint's financial statements in just a minute, but real quick, I just wanted to show you their stock chart lately. Over the past 6 months, it's been a very rough journey for ChargePoint and any shareholders that are still left in this stock. They reached an all-time low of $1.56 per share back in January this year, and currently they're trading for $1.90 per share. So a bit above that all-time low, but still much lower than where it was a few years ago. Next up, we're going to look at ChargePoint's fourth quarter income statement. I've also got the third quarter income statement pulled up right here so we can compare these numbers between the two quarters. The first line here is networked charging systems revenue. This came in at $74 million, and what this is it's basically just the hardware that ChargePoint is selling. So that's pretty much all that is, and that ties into the network charging system's cost of revenue right here, which was $68.8 million. So you'll see ChargePoint made about $5 million or so of gross profit from the actual hardware sales line of their business. Now, if we compare these numbers to the third quarter, you'll see that the revenue number hasn't changed all that much, but the cost of revenue has actually changed quite significantly. It was at $109 million in the third quarter, and then it went all the way down to $68.8 million. So what's the reason for this massive decline? Obviously, it's a good thing that it's a lot lower now, but what's the real reason for this? And actually, it's because of a very large inventory impairment charge that ChargePoint took back in the third quarter. It was $42 million, and basically this is a write-down on the inventory on their balance sheet, basically. And this ends up getting recorded on the income statement under the, the cost of revenue category. And since it was related to their hardware, this is the category where all of that $42 million was recognized at. So if you subtract out that $42 million from this $109 million number, the actual cost of revenue, if you exclude that impairment charge, was actually around $68 million, which is pretty much, again, the same as what it was in the fourth quarter, which makes a lot more sense when you see that the revenue is pretty much the same as well. Next is ChargePoint's subscription revenue, which came out to be $33.5 million in the fourth quarter. This mostly is made up of the cloud software subscriptions that ChargePoint requires their customers to have, but it also includes the Assure maintenance service and ChargePoint as a service, but for the most part, it's just cloud revenue. This is tied to their subscriptions cost of revenue of just over $20 million, and you'll see the gross margins there are much better than they are for their hardware sales business, and they generated about $13.5 million of their gross profit from this subscriptions category, which you'll see was actually the majority of their gross profit. Comparing this to the third quarter, you'll see their subscription revenue has increased just a little bit, as well as the cost of revenue for those subscriptions. And then finally, we have ChargePoint's other revenue category. This is just miscellaneous revenue from other parts of their business that aren't significant enough to have their own category here. This was $8.3 million in the fourth quarter, and it was tied to a cost of revenue of $4.5 million. Comparing that to the third quarter, the revenue was at $5.8 million, and then the cost of revenue was $4.8 million. So after all of that, if you subtract out ChargePoint's cost of revenue from their revenue, you end up with a gross profit of $22.4 million, which was a lot better than it was in the third quarter, when it was negative $23.9 million, but that's mostly just because of that $42 million inventory impairment charge they took out here in the third quarter. Then if you take this gross profit and divide it by their total revenue, you get their gross margin, which was 19.3% in the fourth quarter. This isn't the highest it's ever been. Back in the first quarter of last year, I believe it was around 23.5%, so it has come down slightly as they've lowered the prices on their products. And this is mostly due to, it seems like demand is an issue for ChargePoint right now. They're having trouble moving these units out and actually selling them. As you can see, the revenue is barely growing quarter over quarter, and actually it's down a lot, you'll see right here, since 2023. So really, demand has been an issue for ChargePoint here for the past year or so, and that's also affecting their gross margins as well. Moving on to ChargePoint's operating expenses, the first one here being research and development, coming in at $55.2 million in the fourth quarter, a little bit down from where it was in the third quarter. You'll notice that all of these operating expenses are actually down on a quarterly basis. And this is because ChargePoint has been working pretty hard to lower these operating expenses lately in an effort to, kind of save the business, because they are burning through cash at a very quick rate, as you'll see when we get to the balance sheet. But the sales and marketing category here was also at $33.6 million, while it was at $39.8 million in the third quarter. And general and administrative also has come down quite significantly as well, from $33.4 million in the third quarter all the way down to $26.5 million in the fourth quarter. Then if you subtract these operating expenses from their gross profit, you of course wind up with a negative number. So ChargePoint's loss from operations was $92.9 million. They did say they are working to lower these operating expenses even more, and they said that in the first and second quarter this year, they're expecting these to be in the low $70 million range. So, it's going to be an improvement from where it is today, but even still, their loss from operations is still going to be pretty large, unless they end up getting their gross profit quite a bit higher as well. Moving on to ChargePoint's balance sheet, we've got their cash and cash equivalents of $327 million, which is quite a lot higher than where it was 1 year ago, even though their business has been burning through cash quite rapidly. So you might be wondering where this extra cash has come from. Most of it has come from share dilution. They've got an at-the-market share offering that they've been tapping into over the past year here. And some of it also has come from these short-term investments. 1 year ago, they had about $105 million of those, and those have all since been cashed out and are part of this cash balance. Then they have $30.4 million of restricted cash, $124 million of accounts receivable, $198 million of inventory, and $62 million of prepaid expenses and other current assets. This brings ChargePoint's total current assets to $742 million. And then we've got their longer-term assets. Property and equipment is at $42 million. Intangible assets are at $80.5 million. Operating lease right-of-use assets at $15.4 million. Goodwill, very high here at $213 million. This is mostly related to some of the acquisitions they made a few years ago. And then they've got other assets of $8.5 million. So ChargePoint's total assets by the end of January this year was just over $1.1 billion. Now moving on to ChargePoint's current liabilities, they have accounts payable of $71 million, accrued and other current liabilities of $159 million, and deferred revenue of $100 million. So their total current liabilities are at $330 million. Then their deferred revenue, the non-current portion of that, is at $131 million. Their non-current debt is at $283 million. Their operating lease liabilities are at $17 million. Deferred tax liabilities, $11 million. And other long-term liabilities at $1.7 million. So ChargePoint's total liabilities are sitting at $775 million right now. And the stockholder equity is $327.6 million. So ChargePoint is burning through cash pretty rapidly in their daily operations, and they've only got $327 million left on the balance sheet. So what are some of the options available for ChargePoint? First of all, they've got an undrawn $150 million revolving credit facility that they have had available to them for a while now, but they've never really needed to use it. And in the future, maybe later this year, they may end up needing to tap into that if they need some more cash, which it's looking pretty likely that they're going to need some more cash. But if they do end up using that credit, they'll probably have some pretty significant interest payments to make in the future. Another option for ChargePoint is they could issue new shares like they've done in the past year. Obviously, the drawback there is that it's going to dilute the share price further. And, neither of these two options are that good, for any shareholders here. But it may end up being necessary if ChargePoint's cash ends up dropping too low. I'd also like to remind everyone that ChargePoint has a new CEO, Rick Wilmer, as well as an interim CFO right now, Manzi Katani. These two have been running things right now, and I'd say they're doing a fair job. It's pretty much what you'd expect. It's what they said they were going to do, which is reduce their operating expenses and increase ChargePoint's efficiency. But this ties into another very significant piece of news that I think is very important for ChargePoint in the long run. Just over a month ago, ChargePoint announced this new collaboration with Akbel, a power supply manufacturer based in Taiwan, where ChargePoint and Akbel are going to co-develop new charging hardware, and Akbel is going to manufacture it for ChargePoint. And it sounds like there may be some other companies getting announced in the future that are going to be supplying ChargePoint with some hardware as well. They say this is going to lead to much lower costs for their hardware business, and that it's going to make them a lot more efficient and get products to market a lot faster than what they've been able to do. And maybe that will be true in the short run, but I feel like in the long run, this kind of feels weird, like it sounds like ChargePoint is completely moving away from the hardware manufacturing business. And, if they're not manufacturing the hardware and they're not owning the hardware, then you kind of have to ask what exactly ChargePoint is really doing at that point. One potential path I could see ChargePoint maybe taking in the long run is focusing more on the software side of things. It sounds to me like they are already selling their software, kind of like their charging network analytics and monitoring software to other charging owners that aren't even using ChargePoint's hardware. So they're already kind of doing this, it seems like, and maybe in the long run, they're maybe planning to kind of just shift more and more towards this software side of things for companies to monitor their own hardware that isn't necessarily ChargePoint's hardware. But I don't know. They haven't said anything that really confirms this at all. It still seems like they're very focused on the hardware. And of course, they could always change their plan anytime. Maybe if they get into a point where they're better capitalized, then they start manufacturing their hardware again, or maybe they start owning their own chargers. Who knows? They can always change their business model, just as they're doing right now, it seems. But I think this is a pretty interesting piece of news here that's probably going to be very interesting to see play out in the long run for ChargePoint. So ChargePoint is in a pretty rough financial position right now. It seems like the demand for the products is on the decline, or at least it has kind of stayed flat for the time being, and it's not very clear if that's going to end up picking back up in the future. Their gross profit is still nowhere close to covering their operating expenses right now, and they are working to decrease those operating expenses and get their sales up to raise that gross profit, but until then, they're burning through cash at a pretty rapid rate, and it seems like it's only going to be a few quarters really, until they start to really have some serious problems with their liquidity. Even if ChargePoint is able to get through this inflection point where they reach profitability, it's not entirely clear to me what exactly ChargePoint's long-term advantage in the industry is going to end up being. I think this EV charging industry is very commoditized, and it heavily comes down to the cost that you're able to produce and install these units for. And I'm not totally convinced that ChargePoint is going to end up being a leader in costs here. So I'm not personally invested in ChargePoint stock, but I'd like to hear your thoughts on the company right now. I think they're in for a very interesting next year or two here. So share your thoughts in the comments of this video. That's pretty much all I've got for you today. Thank you guys for watching, and I'll see all of you in the next video.